BlackRock is the largest hedge fund in the entire world. In fact, they are so large that they can't even be measured by billions. Their assets under management has now reached over $10 trillion. I mean, when we talk about giant hedge funds and the rich elites really being what moves the market rather than us individual stock investors, I mean, when it comes to BlackRock, you can be sure that anything they touch is heavily impacted. So, given that the stock market has essentially been crashing all year long, I thought it'd be fun to take a look at the top 5 stocks that BlackRock actually went out and purchased this latest quarter. And to make things even more fun, I'm actually going to give my own personal opinion on every single one of those stocks, and I'm even going to rank them from best to worst based on my own opinion. So, should be a lot of fun. Hope you guys enjoyed. Please subscribe, please hit the like button. Really helps the channel survive. It means a lot to me. But let's go ahead and dive straight into this list. All right, and counting down here from the smallest to largest position in the portfolio, stock number 5 that BlackRock went out and purchased this past quarter was a company called HR, ticker symbol HR, which the fund had already owned for the same amount in each of the past 4 quarters before deciding really out of nowhere to now literally double their position on it this last quarter, buying almost 22 million more shares, bringing their total stake in the company up to almost $1 billion. Now, despite their name being HR, this company actually has nothing to do with human relations. Instead, HR stands for Healthcare Realty. And so this is actually a REIT, a real estate investment trust, basically a company that buys up real estate and then leases it out to customers. And in this case, they use them as medical office buildings and facilities, which is usually a bit more reliable than other types of real estate, like shopping malls, for example, which of course we know have been hit pretty hard in recent years, especially with the retail apocalypse and things like that. As of right now, though, HR has actually grown their footprint to over 700 properties across 35 different states, with sales climbing by millions of dollars every year. When looking at profits, though, real estate investment trusts typically use a figure called funds from operations to more accurately measure their cash flow. And in the case of HR, they actually went through a few years of stagnation before finally popping up by over 20% last year. So while they can sometimes see high growth, I would say that overall it can sometimes be a little bit of a mixed bag. However, I would argue that the best reason to own a REIT is for the dividends. See, REITs actually get certain tax benefits in exchange for having to pay out more than 90% of their profits as a dividend. And because of all the fear of a looming recession and the real estate bubble bursting, many REITs have actually crashed very hard this year, with HR in particular having already lost close to half its entire value, leaving it now trading at the lowest price in over a decade, with also a dividend that has risen all the way up to well over 6%, while their valuation has also plummeted to a price to FFO ratio of less than 12, which is 17% cheaper than the rest of the sector. I don't personally own any REITs myself, but if I did, HR would definitely be high up on my list of considerations. So I'll go ahead and put them in the middle at number 3 for now, since we still need to look at what other stocks are on the list. But I can definitely see why BlackRock went out and doubled their position here, considering how cheap the stock is and how massive that dividend is. Over 6%. That's a very attractive dividend. All right, guys, moving on to stock number 4, we actually have another real estate related company in CoStar Group, ticker symbol CSGP, which BlackRock had actually trimmed their position on a little before deciding to increase it this last quarter by over 40%, buying up another 8.5 million shares, bringing the total value of their position up to almost $2 billion. So about double the size of the stake that they have in HR, for example. However, unlike HR, CoStar is not a real estate investment trust. Instead, they're actually an online platform that provides real estate data to their customers. Most of the time, it's in commercial real estate where they provide various services to businesses across industrial, office, retail, and more. However, they also have a huge consumer business with several popular websites that you might have actually used yourself, like, for example, apartments.com or homes.com, which help users find available homes to buy or rent. And thanks to various acquisitions and just overall strong performance by the company, CoStar has been able to put up some really impressive financials over the years, even during horrible macro environments in commercial real estate, like 2020, for example, where, of course, things were shut down and businesses struggled. Well, they still managed to grow sales by over 20%, and they are still somehow maintaining that double-digit growth rate in future years as well. It's very impressive. But because of their strong diversification that allows them to perform so well even during, difficult periods, the stock has not really dipped much during this year's market downturn. In fact, it's actually still trading near a 52-week high, which has left their valuation at literally hundreds of percents more expensive than the sector. Don't get me wrong, I understand that this is a very high growth stock that therefore deserves a premium price tag. But when you're talking about a gap PE ratio of almost 100, that is much higher than even Amazon, I just think it's stretched a bit too far. And as a result, I'm just going to have to rank them at number 4 for now. It's a great business, really good growth, but that price is just too high for me personally. Alright guys, moving on to stock number 3 though, that's going to be a super interesting play on the future of optics and lasers with another company here that I've never covered on the channel before, and that is Coherent, ticker symbol COHR, which BlackRock had been holding steadily for the previous 4 quarters before now deciding to increase their position on it by a massive 400+%, bringing their total stake in the company up to almost $400 million. And like I said, this is a company that is famous for developing all sorts of different laser and optical systems and equipment related to things like laser cutting, laser etching, optical fibers, surgical lasers, dentistry lasers, even ophthalmic lasers used for eye surgeries. Like, fun fact here, Coherent is actually the world's largest supplier of the lasers that are used for the LASIK eye surgery. Funny story, by the way, I actually almost got LASIK eye surgery myself, and I kind of chickened out at the last minute, but I almost had LASIK eye surgery myself, and it's a very popular procedure. So that's pretty crazy that they're the world's largest supplier of those lasers. But they also work in things like DNA sequencing, remote imaging, and even space exploration. Basically, anything that is laser related, you can be sure that Coherent is involved. And after they merged with rival company IIVI, they became a world leader in all kinds of engineering materials, networking, and of course optics and lasers. The result is that they are now expected to grow their earnings per share by a double-digit percentage on average over the next 5 years, while also maintaining their super impressive revenue growth rates that can sometimes be up and down depending on certain factors, but overall, you're usually talking about double-digit growth rates on both the top and bottom line, which is very impressive. And yet, thanks to the market downturn, the stock has actually crashed this year, losing more than half its entire value from the top, resulting in a dirt cheap valuation now that is more than 50% cheaper than both their own 5-year average as well as the broader sector on an adjusted basis. That's pretty crazy. Personally, I think that the stock is a very solid pickup right now for the long term, and while I love the dividend of HR, I just gotta put Coherent slightly above them at number 2 because I think they have a super interesting business for the long term at a dirt cheap price. Alright guys, we are now down to the final 2 stocks, and coming in here at number 2, that's going to be an iShares ETF that is actually issued by BlackRock themselves in the core MSCI Total International Stocks ETF. International stocks, an international stocks ETF, which unsurprisingly BlackRock has owned a large amount of for a very long time and slightly increased their position a little this last quarter by just above 6%, bringing their total stake in the ETF up to over $13 billion. Now, I'm not personally a huge fan of ETFs myself because I enjoy handpicking my stocks individually. I think it's a lot of fun and I don't mind doing the individual research, so I like to just pick them out individually myself rather than taking like a large basket of them. But, the great thing about ETFs that I will always point to is that they are fantastic for diversifying your portfolio into a large amount of stocks without having to do so much individual research on every single company that it holds. And in the case of this ETF in particular, I mean, it gives you great exposure to stocks outside of the United States, which, is a hard thing to do. It's hard to keep track of companies outside the US or outside the country you live in. But, in this case, I mean, they've got broad exposure here. They got Japan making up more than or about 15% of its value. And then they've still got significant exposure in many other countries and regions like the UK, Canada, China, India, Europe, and even Taiwan. Very good broad exposure internationally. I think it's a really good balance of risk and reward as far as like international markets are concerned. In terms of sectors, it's also spread out pretty well across many different areas, but I would prefer to see less money invested in financials, which takes up about 20% of the ETF. And instead, I would move that money over to technology, healthcare, consumer options, energy, real estate, materials, utilities. I think all of those could use a little bit more money that could be taken, a little bit from financials. I think it's a little too heavily reliant on financials, but overall, it's still pretty good. And I think it's well diversified across more than 4,000 total stocks. It holds a lot of stocks. Speaking of which, I also like that the top 10 holdings only make up less than 10% of the ETF, which means no individual stock can really cause too much damage to the ETF. And even some of the largest holdings are still very well recognized and reputable companies, like, for example, Taiwan Semiconductor, who is a leader in chips manufacturing. They've got Tencent, who is a leader in tech, gaming, and social media. Samsung, who owns the second most market share of smartphones just behind Apple. And there's several other companies on here that I like a lot too. But because of the market downturn, the ETF has actually dipped pretty hard this year, having lost about a quarter of its value from the top, leaving them with a pretty good PE ratio of less than 12. For reference, the S&P 500 is like 20. So, quite a bit cheaper than that, but it is international stocks and, compared to S&P 500, you would think it'd be cheaper. But also their dividend yield is pretty good and it's risen to above 3% with a double-digit growth rate. I think that's pretty attractive. Plus, they have a really cheap expense ratio of less than 0.1%, which is about 80% cheaper than the median of all ETFs. And overall, I just think IXUS, this ETF here, I think it's a solid long-term choice for anyone wanting to diversify into international stocks while limiting the risk and also getting to collect an attractive dividend along the way. And because of that unique offering to investors, I'm actually going to rank them just slightly ahead of HR at number 2 and bump up Coherent to number 1 so that I can fit it in. Alright guys, that's going to leave us now though with the final stock of the list. And boy, does this one have a chance here to just throw this entire ranking, out of whack. Because that stock is none other than the almighty, very popular Tesla, ticker symbol TSLA, who BlackRock has been mostly holding steady, but also increasing the position a little in recent quarters, with another almost 6 million shares added this latest one, bringing their total stake in the company up to a whopping over $45 billion. And I mean, the steady buying, I think, does make sense here when you consider just how much the stock has been crashing over time. We always say be greedy when others are fearful, and I'm not necessarily saying that Tesla is a great buy, but in the case of BlackRock, they certainly think that the fear is unwarranted, as the stock has now crashed by almost 60% from the top, which, as a Tesla shareholder myself, I actually agree with a lot of that crashing because it had initially climbed by way too much in 2020 and 2021, and I thought it was overvalued. But seeing the stock crumble now by this much, I think it's starting to look pretty attractive once again, especially when you consider that the macro environment that Tesla operates in, I think actually benefits Tesla right now. Now, I know that may sound weird considering how horrible the economy is with record high inflation and rising interest rates that can certainly discourage consumers from going out and dropping tens of thousands of dollars on new luxury vehicles like a Tesla, which, by the way, with Tesla specifically, because of the giant inflation, I mean, their cheapest Model 3 is still starting at a whopping $47,000. That's way higher than the $35,000 that they had originally planned for it. However, in this current environment where gas prices have soared through the roof, people just cannot buy electric cars fast enough right now. Like, literally nobody wants gas cars anymore, and they're all trying to get their hands on electric. And the result of that is that Tesla has been selling literally every single vehicle that they can make. High inflation or not, it doesn't matter. They've been raking in sales on those cars, even if they're priced much higher. And the result is that they've had crazy revenue growth, soaring from 14% in 2019 up to 28% in 2020, and then a mind-blowing 71% in 2021, at a time when most other automakers have actually been struggling. And even looking ahead, Tesla is still expected to rise by another 55% this year, with another 40% growth on top of that expected next year as well. And here's the kicker, guys. Revenue growth isn't even the best part of Tesla. That's their insane profitability, with industry-leading margins of 26% versus legacy automakers like Ford and Toyota, who only do around 7 and 5% respectively. Tesla, though, operates like an insanely expensive supercar brand, and really there is zero sign of them slowing down, because their earnings per share are also expected to skyrocket by over 50% a year over the next 5 years. That is unheard of for these automakers, and it's why their PEG ratio, their price to earnings to growth ratio, is only about 1.5. I mean, for how much everyone always says that Tesla is so much more expensive than the legacy automakers, I mean, I agree, Tesla is an expensive stock, but keep in mind, when you factor in the growth, their PEG is only 1.5. The sector is just barely cheaper at 1.4. And even General Motors, who, is a very legacy automaker, they're only about 1.1. So they're not like that much cheaper. And then you add on the future growth potential of the semi in logistics, the Cybertruck for truck owners, you've got the robot for business, manufacturing, and office work, and even consumer households. You've got their leadership in autonomous driving with the future of robotaxis. You've got their work in energy and battery storage. There's just so many reasons to think that Tesla can still maintain some very high growth rates well into the future. And look, I'm sure I'm biased here because it's the only stock on the list that I actually own myself too. So, disclaimer, it is a stock I own. I'm probably biased. But I just think that the purchase here by BlackRock does make some sense. And I'm actually going to rank Tesla as number one because at the end of the day, it is the only stock that I actually own myself. So I got to rank them high. And I just think that their business is quite a bit more attractive than the other stocks on the list. At least it's the business that I know the most about. So for that reason too, I feel like I still need to do more research on the other stocks. So this is going to be my final ranking, guys. I'm going to put Tesla at number one for the business and the future potential. I'm going to put Coherent at number two for the awesome valuation, the high growth, and the very cool and interesting business. I really like that stock. The international ETF at number three. I think it's a great option for anyone trying to get more international exposure. HR is going to go at number four. I think it's a solid dividend rate. And then CoStar at number five, who I just think is too highly valued and not really as exciting as the other stocks on the list. But yeah, overall, I think I'd say that I like these pickups by BlackRock. I think there's a lot of stuff here that makes sense. There's a good balance here between value and risk and even a dividend. But what do you guys think? Do you agree with my rankings here? Would you make any changes to it? I'd love to hear your thoughts. Do you own any of these stocks? What do you think about them? Let me know down in the comment section, and let me know if there's any other videos you guys would like to see in the future, and I'd be happy to make those videos for you. Thanks again for stopping by, for all the support. Hope you're all doing well, and I'll catch you in the next video. Take care, everyone. Bye-bye.